mean? 0%! So it's free? No, Nick. Then why does it say 0? Because you never read the fine print. So what's the catch?
Here's the catch. $100 and 4 payments of $25. Those are two completely different receipts for your brain. You look at a pair of sneakers for $100 and something inside hits the brakes. Too much. I'll wait. Now take that exact same price tag, but put a small button under it. Or 4 payments of $25. Klarna, Afterpay, Affirm. The sneakers didn't get any cheaper, but I'll wait, that just evaporated. Handing over cash used to hurt. The card dulled the pain. Pay in 4 removed it completely. And stores are happy to pay for that. Not 2% like a regular card, almost 6%. So why do merchants gladly hand over 3 times more just so you don't get a chance to think? Why does this work on your brain? When you pay cash, the pain is maxed out. You hand over the bills with your own hands and you physically watch your money shrink. A card is weaker. A phone is weaker still. Glance, tap, walk away. Somebody measured that gap back in the early 2000s. At an auction for basketball tickets, people paying by card bid twice as much as people paying cash for the exact same seats. Although it's worth adding a caveat here, today that effect is smaller. In 2024, a big review of dozens of these studies came out, and the conclusion is simple. We got used to cards. The painkiller wears off over time, the brain adapts, and the old brake wears out on its own. So to keep us spending, a new tool was needed. Normally, the joy of buying and the pain of paying happen at the same moment, and they cancel each other out. A card pulls them apart. You take the thing home today, and the bill shows up a month later. Pay later takes the next step. It cuts the number itself, and suddenly the purchase feels light and easy. If you're not paying a cent extra and you close it out on time, where's the register? How do these companies make their money? Look, when you tap your card at checkout, the store hands the bank 2%, 3% at most. That's normal card processing. But when you hit pay in 4, the service takes 5 to 8% off that store, 3 times more, and retailers cry and pay. Question: where does all that generosity come from? Because a person with the pain sensor switched off is the perfect customer. You came in for 1 pair of $100 sneakers, and you walk out with 2 pairs and a hoodie, because it's only $30 a week. You see the idea? And this is the moment the whole thing flips. You think the pay later service is working for you, saving you money. In reality, the service is selling you, warmed up and ready to buy anything, to that specific store. But understand, no store can just eat an 8% loss on every sale. It simply bakes that fee into the price of everything on the shelf. Which means your little fake installment plan was already paid for by that boring guy in line who counts out exact change in cash. Funny, but true. Here's the funny part. Pay later used to be for couches, iPhones, expensive clothes. But in the spring of 2025, delivery apps let you split into 4 payments. A food order. Twitter tore itself apart over one post. Happy to announce I've taken out a mortgage on $30 of burrito and chips. 20-year fixed-rate financing provided by a buy now, pay later service. Congratulations to all parties involved. The services made excuses, of course. This is for people who order headphones along with the pizza. Sure, we believe you. Now let's look at the numbers. In a single year, more than $150 billion ran through this scheme. The market for small installments nearly doubled. The average loan is $135. That's not a television. That's a normal weekend run to the supermarket. Almost 1 in 3 people taking pay later is taking it for food. 2 years ago, it was half that. The precision tool for big purchases they sold you has quietly sunk to the level of instant noodles and bananas. And the best part? Most people aren't on one plan. They're on 3 to 5 across different apps. $8 comes out Tuesday, 12 more on Thursday, 15 on Sunday for those chips you ate 3 weeks ago and forgot about. One by one, it all looks like pocket change. Who's going to lose sleep over $10? But stacked together, you get what finance people call phantom debt. Want the most cynical trick of all? The one these services stay quiet about? While you were enjoying your 0%, they quietly swapped out the product itself. Let's look at fresh Federal Reserve data. Out of that whole giant pile of loans, the classic 4 payments at 0 is only half of it. And more than a third of all the money is now ordinary interest-bearing loans. A good old credit card in nicer packaging. At one of the biggest players on the market, it's even more blatant. The interest-free splits are barely a quarter of their volume. Everything else is a classic loan. You were simply trained to take on debt with one tap, without reading the fine print. The second flywheel of their profit is your forgetfulness. 10 days late on a payment? Here's your fee, $10. Sounds harmless enough. But if you bought sneakers or food for $40, $10 is a quarter of the entire purchase, in 10 days. Convert that into an annual rate, and you get a wild 3-digit number that any street loan shark would envy. And here's the number this whole breakdown is really about. Open these companies' reports for investors. Delinquency, under 2%. Perfect picture. The borrowers are angels, and the banks are smoking nervously off to the side. Now the surveys of the actual people. The Federal Reserve asks, more than a quarter admit they've been late on a payment. An industry survey asks harder, and there it's 47%. Two different samples, but both many times higher than what investors are shown. How did 2% turn into 47? Where's the magic? The magic is in the terminology. You're a week late, the system slaps a $10 fee on you, you scrape it together and close it out, and that's it. For financial reporting, you're a perfect client. You're not a delinquency, you didn't spoil their statistics, and you never hit your credit report. You just handed them pure profit out of thin air. Their entire business doesn't rest on people making 4 payments on time. It rests on that gap between 2% and 47%. Here's where I have to step on the throat of my own source list. Otherwise, this turns into a cheap horror story about how they're all going to ruin you. There's no catastrophe. The economy isn't collapsing. There's no army of bankrupts marching down the street. More than that, PayLater has one rock-solid argument that credit cards have nothing to answer with. A credit card is an endless financial loop. Interest piles onto interest, the balance spins for years, and you're stuck in there forever. PayLater is built more honestly. It's a surgically precise loan with a clear ending. 4 steps and you're free. And one last thing, look at who's actually borrowing. Among people earning $25,000 to $50,000 a year, 1 in 4 uses PayLater. Among high earners, half as many. For a huge number of people, this stopped being a gimmick for impulse buys online a long time ago. It's how you stretch to payday when a normal bank won't give you credit anymore, and you still need to buy things or fix the car. Very often, it's the last access to money they have left. Bottom line, this isn't a scam. It's a brilliant product. No complaints about the execution. It honestly cuts your bill into 4 pieces. The problem is the logic. PayLater is free for you and expensive for the store on exactly one condition. You have to spend more than you planned. Take away the bump in the average basket and the scheme collapses tomorrow, which is why the real competitor to PayLater isn't the credit card. The real competitor is that 1 second when you look at the price and close the tab, and the store buys that second for up to 8%. For 20 years, one break after another has been taken off our spending. Cash was replaced by the card by the phone, passwords by a face scan, card numbers by autofill. They sold it to us as convenience, but the price is always the same. The part of your brain that handled the pain of spending lights up a little weaker every year. They didn't cut it out. They just taught it to stay quiet. 4 times 25 is still $100. Your brain was simply trained not to feel it. Tell me in the comments, right now, without opening your phone, can you name the exact amount coming out of your account this week?